I am Abhinav Harlalka, a senior member of the real estate practice at Nishith Desai Associates. I would be dealing with the impact of Budget 2016 on the real estate segment. The first aspect I would be covering would be on the fundraising side. Till now, FPIs or registered FPIs offshore were allowed to invest in listed bonds issued by corporates in India. These bonds could be listed or to be listed. The finance minister in the budget speech has now proposed to expand the scope of the instruments into which FPIs can invest to include unlisted bonds as well. This would be a major shot in the arm for foreign portfolio investors to invest in India, since it would remove the entire hassle of listing of these debt securities on a stock exchange in India. In self-liquidating assets like real estate, upstreaming of capital becomes an important aspect to be considered. While a large number of companies resorted to debt structures to upstream capital, in cases where this was not possible, they resorted to buyback, which resulted in capital gains in the hand of the investor. However, buyback also resulted in a 20% tax in the hands of the company. To avoid this, companies tried to resort to redemption of capital or capital reduction schemes, which were selective capital reduction schemes, to avoid this tax. However, it now seems that the budget 2016 has sought to remove this loophole, which would now result in capital reduction, redemption of instruments, and buyback being considered at an equal footing. The third aspect with respect to real estate was in the form of exemption for DDT, which is dividend distribution tax for REITs. One of the long-standing demands of the industry was exemption from dividend distribution tax for core asset holding SPVs which were monetized by the sponsors. While some cases were properly structured, having enough debt to equity ratio, in some cases which were not leveraged enough, there was a dividend distribution tax to be paid. This exemption for DDT would be a fresh lease of life for REITs. Sponsors who were looking at private placement or alternate structures to unlock core assets may now look at REITs as a new option, which is lucrative to them as well.